Hey everyone, this is Mark Treichel with another episode of With Flying Colors. Today I'm going to walk through some of the items in the NCUA's Inspector General's last report to Congress. This is something I probably will do every 6 months. NCUA and every federal agency is required to file a report with Congress from the Inspector General on how the agency is responding to the requirements of the Inspector General. I've also started to monitor what the FDIC and the Fed and Treasury related to OCC is saying in their semiannual reports, and I'll have a separate podcast on that. But, if you're wondering, if you're watching this on YouTube, you can follow along. If you're listening, bear with me here as I point out how to find these reports. So on the NCUA website, you go to About and you go to Inspector General. And you go to reports, see more, and you go to semiannual reports, then letters to Congress. And you can see their last one was from the period of April 1st through September 30th of 2025. And that's the one I'm going to be reporting on. And this was sent to Congress on, October 22nd. So what's that? 30 and 22, 52 days after the end of the quarter. So at the end of March, add 52 days, we're looking at possibly having a report to Congress come out by the end of May. This podcast that I'm recording will come out about that point in time. So when that new one comes out, I'll jump on it and see if there's anything else I want to add to it. But you can see the report has a message from the Inspector General, goes through NCUA's mission, shows their organizational chart, shows some key financial trends, legislative highlights, a summary of how the IG works. It walks through the audits that they've done. There was nothing in particular there that caught my eye. And scrolling down to report on credit unions' non-material losses. So the insurance fund, NCUA, the IG has to conduct a material loss review of any insured credit union if the loss to the insurance fund exceeds $25 million and an amount equal to 10% of the total assets of the credit union at the time in which NCUA initiated assistance or liquidation. So there are none that hit that this cycle. But if it's less than that, they report on credit unions of non-material losses, and those are the ones that I want to walk through here. And with that, I have let's see, how do I get to my PowerPoint here? Bear with me. The PowerPoint should be right here. And I am sharing the screen, and we will go to the slideshow on the PowerPoint. Pause. Now I want to jump to the PowerPoint I put together on the fraud cases, or the fraud files, as I call them, for this particular episode. And this comes from the IG report from October 2024 to September 2025. We're going to walk through a pattern that's there. We're going to walk through the IG. I mentioned to you that I'm going to be doing IG reporting on a semi-annual basis, and then I'll also follow up on what the other banking regulators are doing. We're going to walk through the 7 failures in the quarter, talk a little bit about the fraud triangle, and talk a little bit about the history of the IG and some reports, talk about some examiner behavior that this will trigger, walk through a prevention playbook on what you can do to prevent fraud, and then talk a little bit. I've got a separate podcast on why exams have to be on site, and we'll talk through a little bit about that. So there are 7 failures that occurred from October 2024 to September 2025, and those are failures that cost the insurance fund money. You had Total Community Action Federal Credit Union in the southern region with a slight loss of $5,380. The root causes there were weak leadership, record keeping, and inaccurate books. You have Unilever Federal Credit Union in the eastern region, failed in April of 2025 for a cost of $8.44 million. There was internal fraud there, hidden borrowings, and falsified liquidity. Eastern Kentucky Federal Credit Union, the Southern Region in June of 2025 for a cost of $1.47 million. Management lost visibility into the loan portfolio is the note we have here. Seoul Community Federal Credit Union, the Southern Region, June of 2025 for a loss just over $91,000. Caused by insolvency. Yes, well, insolvency is caused by loan losses or write-offs or Federal Credit Union Act violations and unsafe and unsound operations. Butler Heritage Federal Credit Union in the Southern Region, $192,000 in June of 2025. You had record-keeping BSA and IT compliance failures. Aldersgate Federal Credit Union, Western Region, July 2025, $7.98 million. This was a management level fraud. Loans and share accounts were abused. So that would have been fake loans or not recording book shares on two sets of books, essentially, most likely. And Members First of Maryland Federal Credit Union in the Eastern Region, August of 2025 for a loss of about $230,000. They had pervasive record-keeping problems and declining net worth. You can see if you're watching, the two items that are highlighted in pink were internal fraud cases and Eastern Kentucky. Now that doesn't make sense. Why is those showing us pink? Internal fraud cases. And you also had Aldersgate management level fraud, which is internal fraud cases. So ignore the reference to the pink. So what we have here, you can see the two largest losses. Unilever Federal Credit Union was internal fraud, $8.44 million. And Aldersgate, $7.98 million, almost $8 million. So two losses, the two biggest ones. One just over $8 million and one just under $8 million had fraud driving the train. And what happens when people aren't watching? Fraud happens. And when you have 27% less staff, there's less people watching. So I think what you're going to see over these next cycles, the next 1, 2, 3, 4, 5, 6, let's call it 6 reports to Congress every 6 months. They have to report to Congress. So I'm going to say over the next 3 years, I think you're going to see bigger losses that pop up here just because of the fact that NCUA has less people there. And I'm not saying that they shouldn't have done what they did. I'm just saying that when you have less people stopping by credit unions, the likelihood of fraud goes up. It's just like when you see a police car in the middle of the road and they don't have anybody in it, it makes people slow down. You see the police car, you slow down. You see the examiner, sometimes you slow down. So what does this data tell you? There were 7 credit union failures. There were $16 million plus from fraud alone. Those are the two, Unilever and Aldersgate combined. 4 of the 7 losses had record-keeping failures, TCA, Butler Heritage, Member First, and Seoul. And 50% of the fraud was from the inside. Key takeaways, 2 failures, Unilever and Aldersgate were driven by internal fraud. Both involved trusted insiders with system access, insufficient oversight, and falsified records. The boards in both cases were making decisions based on numbers that had been deliberately corrupted by staff. The 3 elements that enable every fraud, what are they? Pressure, opportunity, and rationalization. That's the fraud triangle, if you will. That's if you read up on fraud, if you're a certified fraud examiner, you know far more than me on this. But from the pressure side, personal financial stress, lifestyle, debt, workplace performance demands. Alone pressure is not enough, but it's the ignition. It lights the fraud. Opportunity, access and authority, and insufficient oversight, often structural at small credit unions. The most controllable element, design your organization to limit it. But again, if you're super small, sometimes that is difficult. Rationalization, I'll pay it back. They owe me. The longer someone is trusted, the larger the fraud losses tend to be. The ACFE finding internal control weaknesses drove nearly half of all occupational fraud, not phishing attacks, not external attackers. NCUA trains certified fraud examiners because this framework maps directly to what examiner finds. Now, NCUA doesn't do fraud exams, but they do have certain people on their team that are fraud examiners. They do let those folks take some of their continued development to enhance that. But again, with 27% less staff. I imagine some of those fraud examiners took the buyout. The fraud triangle in action, you've got the case studies of Unilever and Aldersgate. The loss on Alders and Unilever, 8.44 million. Two trusted employees were involved. What was the method? Hidden borrowings and falsified liquidity reports. So they were borrowing money, but not putting it on the financial statement. Again, the board was making decisions on information that wasn't accurate. And again, on the fraud opportunity, they had system access. They had no dual control. They had rationalization, insider trust accumulated over time. So they've been there a long time. Everybody trusts what they say. Aldersgate, July 1st, 2025, just $2,000 under $8 million. It was management themselves, not a rogue employee. Fraudulent activity across loans and share accounts. That could be taking funds from inactive accounts, booking fictitious loans. Those are the kind of things you typically would see at NCUA for these type of situations. And it was the worst case of governance failure. The perpetrators ran the institution, ran the credit union. And again, opportunity, highest level access, no oversight and rationalization, and we're operating without any accountability. The outgoing IG's legacy from the early 2000s, NCUA's examiners don't look for fraud. The position was examiners don't look for fraud during exams. The inspector general pushed it because of fraud, material loss reviews. Fraud at small credit unions kept causing share insurance fund losses. Progress was made. NCUA adopted examiner fraud checklists, robust scope steps, job aids, and fraud-related procedures. The result was there was a reduced fraud losses to the insurance fund. Now, Jim Hagan retired as part of the buyout, and the acting IG, Marta Urseg, has the advantage of the fact that these things have been put in place under the prior regime, and she also worked for Jim Hagan when I was there at NCUA, and is very capable of leading the IG. Now, however, again, with 27% less staff, what has that done to NCUA's use of the fraud checklists? The steps that they take is part of their exams. They have to cut in certain places, and if they cut in the fraud area, it will likely potentially lead to fraud increasing, moving forward. Examiner behavior, what they're pattern matching against, the loan portfolio. Do you know what's in your book? Loan stratification, concentration reports, delinquency trend analysis by product, vintage, and originator. Are people looking at these reports to see if something pops out? Liquidity reporting, Unilever. Is anyone independently verifying these numbers? Again, coming back to the supervisory committee. BSA and record keeping. NCUA has a zero tolerance for record keeping problems. If you have record keeping problems, you will see them every quarter, not every 120 days, not every 180 days, not every year, not every other year. You will see them quarterly. Now, what they do when they show up, are they pushing you to get an audit? Are they pushing you to make sure that things are resolved? So if you see these accounting issues causing losses, that means that the credit union failed, the supervisory committee failed, and NCUA failed probably in what they were looking at. Getting to the supervisory committee, all 7 of these situations, the supervisory committee is your first line of defense. Are they doing their job? Are they being listened to? And then IT controls. This was an issue at Butler Heritage. It's something that every NCUA board member has said they lose sleep at night because of the IT side of things. I lose sleep on that side of it, but they haven't had a lot of losses tied to that, but maybe that'll be something that comes soon. Now, smaller credit unions, less than $50 million in assets, their biggest vulnerability is structural. They have limited staff, which creates opportunities for default, and you can compensate that with active oversight of the supervisory committee or whoever does your audit. Looking at account maintenance reports, mandatory consecutive vacation. That's another thing they teach you in the fraud classes. Surprise cash counts, anonymous reporting hotline, bond coverage review. Do they have the right coverage? Because these losses can be recovered sometimes. And the annual fraud-specific audit inquiry. Auditors should ask directly whether management is aware of any fraud. When I was the executive director at NCUA, the CPAs would sit down and they would ask me that, and I would have to sign a letter saying that I was not aware of any fraud at NCUA. Same type of thing happens in the audits. Mid-size and larger credit unions, 50 million above. You get into behavioral analytics and AI monitoring, which is a new tool where you can watch outliers, role-based access controls, internal audits. Of course, these credit unions can afford internal audits and could do fraud-related reviews, and they can do more granular loan portfolio visibility with the resources that they have as a larger credit union. Now, the living fraud risk assessment, you've got member risk, you've got product risk, and you've got enterprise risk. On the member side, who are your members? What channels and products do they use? Are onboarding controls adequate for the risk profile? Of course, you have people pretending to be who they're not, and you see a lot of fraud in that arena. Product risk, which products carry the highest fraud exposure? Business accounts, digital channels, loan products with minimal documentation. What specific things are you doing at your credit union where you could perhaps enhance and make your procedures more robust? And then enterprise risk, the most underinvested assessment, given your current control environment, where are the most exploitable gaps right now? And then having someone look at those gaps. Now, why virtual exams will never replace on-site exams? They need to see you, right? NCUA can do a lot of things offsite, and they can identify anomalies. But coming in, looking at loan files, asking questions, walking through their fraud checklist, looking at account reconcilements, ticking and tying the financial statement from an NCUA perspective can reveal fraud. You also, when NCUA shows up, my guys here on the podcast have talked about, you pull your sample of 30 loans. Well, they bring you 35 because somebody knows those other 5 loans are fraudulent. That does happen. So just showing up, you have whistleblowers who don't blow the whistle, but they kind of point NCUA staff in the right direction, which is why, again, having a good, well-trained exam team and having on-site exams is something, in my opinion, that'll never go away and never should go away. So 5 things to take back to your credit union from this. Fraud can come from the inside. 2 of the 7 failures were internal, combined losses over $16 million. Your greatest fraud risk isn't external hackers, it's insider access without oversight. The opportunity is the controllable element. You can't always detect pressure or predict rationalization. You can design your organization to limit opportunity through segregation of duties, dual controls, and mandatory vacations. Record keeping, number 3, record keeping failures compound every other problem. 4 of 7 failures had significant record keeping issues. Inaccurate records don't just fail the auditors, they fail your board, your examiners, and your own decision making, and of course, your members. Examiners are pattern matching. Every hard question about your loan portfolio, liquidity reporting, or supervisory committee activity has a failed credit union behind it. They're not adversaries. They carry institutional memory about failure. Some of these questions are to try and figure out if there is fraud. And lastly, the fraud risk assessment should be alive, not an annual review. It's not something you can just check the box. It's something you need to be looking at all times. Ask the uncomfortable questions. Where does opportunity exist right now? And who in your organization might already feel pressure? All right, that's a wrap on this episode of what I'm calling the Fraud Files. Watch for more frequent discussion about what NCUA is saying in their IG reports and what the other banking regulators are saying in their reports. And with that, I'm going to stop sharing and I'm going to click thank you for listening. Thank you for watching. As always, this is Mark Treichel signing off. I hope you'll listen or watch again soon.